Today, we're looking at 5 stocks that definitely deserve a permanent place in your investment portfolio. If you're a beginning investor or if you're a more advanced investor just looking for some additional stocks to add to your portfolio at this time, these stocks will definitely make the spot. And if you are considering why we should pick just these 5 stocks, we'll get more into that in detail. But first, welcome to my channel. My name's Thomas, and on this channel we are looking at everything that has to do with passive income. How you and I can grow our investment portfolios and make the best out of the money that we have. So if you're new here, please remember to like and subscribe, and let's just jump into it. But before we go into the actual stocks, there's a couple things that we have to know about these companies to see if they are suitable or not to put into our portfolio. So I made a little bit of a checklist that we can tick off and as we go along. And there are some points here that you should definitely add into your permanent research and make sure that you check these off every single time you're looking at a new company, because some of these will be very valuable. So first off is history. Does the company have history? If there's a lot of history here, you should be able to see how the company has been doing in markets before. How did the company handle bear markets, bull markets, the financial crisis, upward, downward, all these kind of things. If there's a long track record of the company, you should be able to see how management and investors has been doing and dealing with these things previously. So this is always going to be a valuable point. Check the history of the company. If they have a long history, make sure to go back and research. Check how they did, what the kind of management style they have. All these kind of things should be able to find if you go back through it. Read annual letters, all these kind of things that have been sent from management to the investors to see how is the communication going. How are they oriented toward their investors? Are they more about building a strong company? All these things you should be able to tell from the history of the company. So this is not always about finding the hottest, newest brands. The companies we put into our dividend portfolio is usually old. They have a long track record and they have been paying out for a long consecutive time. This is a quality stamp when it comes to dividend investing. You won't find a lot of these unicorn stocks out there today that is going to skyrocket tomorrow that will pay out strong dividends because they are still in their growth phase. While the more established companies that we're going to look at in this list, they have a long track record, they have already a dominant market position, and they have the strength to keep paying out their dividends no matter what kind of market we're in. Next out, you should always look at the price earnings ratio. You should never invest on price earnings alone, but it's always a very valuable tool to see if the company compared to other peers is overpriced or undervalued. The average S&P 500 has been around 13 to 15 times price earnings, but now you can see that many of them are above 20, which means we are still in quite a expensive market, and quality stocks will always be expensive. So you should be able to calculate historical price earnings for the stocks that you're looking at to see if they are currently expensive or not and how they are doing long term. Remember, we are doing this for long-term investing. Dividend portfolios are not something that is going to jump from one day to another. This is a long run and we are trying to keep the more steady pace here. So we are not looking for the growth stocks. We are definitely looking for more solid, steady companies that is doing their payouts at a more or less a normal schedule and what they've always been doing previously. Number 3 on our little checklist is the dividend yield. You should always be careful with companies that have a high dividend yield. They might look very attractive as an investor, but there's usually something else underneath the surface on these companies, because paying out a high dividend is usually a very large strain on the company's finances, which means that a lot of these companies paying out incredible dividends are usually heavy loaded with debt, or they have a very tight budget going out to be able to pay out these dividends. So I would always look for companies with a sweet spot between 2 and 5% dividends. Try to be at 3.5, 4. That's pretty much the sweet spot on this level. You can always add a couple high dividend yields stock to your portfolio, but try to sprinkle the portfolio with these ones, not build it around them, because there is a higher chance for these companies to get into struggles, and when they get into struggles, the first thing they usually do is cut their dividends, which is what we're trying to avoid here by keeping to the sweet spot instead. So if you found a stock that you're considering buying but it has a very high dividend yield, I would also check the sheets a little bit extra. Check the annual reports, check all the finances, all this kind of stuff in detail, because there might be a hidden burden of debt somewhere that they are trying to hide from the investors. Because we have seen this time and time again that companies paying high dividends, they are using loans to pay out the dividends to the investors to keep the pace so high. and at some point the house of cards is gonna collapse. So the rule of thumb here is try to keep it between 2 and 5% dividend. Look for those consistent payouts instead and a long track record rather than having huge payouts in short term. Alright, so last and probably one of the most important things on our checklist is check the payout ratios. This is how much of the incoming money the company pays out to their investors, and this is a very important thing. The company should never pay out more than 60%. That is the top limit. They should never pay out more because that is going to be a strain on the company's finances, and at some point that could be bad when we are entering a new bear market. Personally, I like to use Seeking Alpha, the website, to see all this kind of thing. They have a very great system that shows you all these key numbers in detail, and it's very easy to navigate. So if you want to check that out, there's going to be a link down in the description below. So go check out Seeking Alpha and have a look at their dividend tools. So with that little checkpoints marked off, let's just get into the 5 stocks that I think you should buy and keep forever. So with all that in mind, let's just get into the list. First out on our list is one of my favorite companies, and that is PepsiCo. PepsiCo is probably most known about their soft drinks, but they also have a vast amount of other brands, including breakfast cereals and salty snacks, all these kind of things that make them a diversified company. You would probably compare Coke and Pepsi, but while Coke is mostly just fixed around their soft drinks, I mean they have a large brand of soft drinks, but it's all drinking beverages. PepsiCo has been more diversified. They have breakfast cereals, they have salty snacks, all these things that could go along their soft drinks. So if you take a quick look at their product portfolio here, you're gonna see that there's a lot of different brands here. Most of them you probably seen around your store somewhere, but you probably never considered that it's PepsiCo that is making them, because they're not really something that you would consider combining with Pepsi. But this is the great thing about the company. They have diversified into so many household brands that even though people are drinking less Pepsi and soft beverages these days, people are still buying salty snacks, people are buying breakfast cereals, all this kind of stuff that is part of their portfolio. So with this kind of diversification, I think PepsiCo is a great additional to any dividend portfolio long term, because they have proven time and time over again that they're able to adjust to time. They have changed their brands, they have invested in new companies, and they always acquire more companies. The latest one is SodaStream, which is kind of going against their main market in soft drinks, because you can now produce it at home instead of buying it. But this is just giving PepsiCo another brand to support their incomes. So I would definitely recommend buying PepsiCo at the right price, but do make sure to look at the price earnings long term and see when you should get into this stock, because it might be overpriced right now, but they always go up and down. So there will come a new sweet spot when this should be added to your portfolio. So if we get into some more details about PepsiCo, they have 121 years of history behind them. The company has been running for 121 years. They have been paying out growing dividends for 48 years. And they are just in the middle of that sweet spot with 3.01% dividend yield, which means that this company is going to be sturdy no matter what. They've been through a lot in those 120 years, and they have proven themselves to be able to weather both bear and bull markets. So next out on our list is Johnson & Johnson. Johnson & Johnson is a pharmaceutical company, but they're also a medical equipment company and consumer goods company. The company is structured as a holding company, and they are running more than 250 subsidiaries around the globe in more than 60 countries. They are one of the most valuable companies in the world, and they have a cash-strong, solid business infrastructure. They produce anything from surgical equipment to more like skincare for the consumers, and they are also doing pharmaceutical research and production, which means that even though it's one company, they are pretty much have 3 different legs standing at, and they're all strong business. So if we go back to our little bit of a checklist on history, the company is 134 years old, which means that they can definitely tick off that box and are still strong going. Dividend yield is a little bit lower than the other one. It's at 2.73%, but it's still within that sweet spot, which should be between 2 and 5%. So it definitely makes the list there, and they have been proven themselves that they are willing to pay out dividends no matter what kind of market it is, and they have 57 years of consecutive dividend growth. So if you don't already have this stock in your portfolio, it definitely deserves a spot there. So next out on our list is another American giant, and that is Caterpillar. Caterpillar has been producing heavy machinery, renting out services, and doing maintenance on machines for more than 95 years. And is there one thing that society will not stop going forward, is building. They will always be building stuff, expanding, improving, or maintenance in buildings, which means machinery from Caterpillar will always be in use and needed. And one of the good things here is reputation and track record. Heavy machinery, pretty much like airlines, is something that is going to take a lot of investing getting started in. There's a very slim chance that you're going to see new companies starting to produce heavy machinery, as the startup cost for getting this infrastructure and factories and all this stuff is so heavy. There is a few main competitors in this segment, and Caterpillar is definitely the market leader. They don't have the same record as the other companies we've been looking at previously, but with 95 years since establishing and almost 17 years of dividend growth, they still do make the list pretty well, and their 2.9% dividend yield is pretty much just about the sweet spot as well. So I think this is the company that you should own if you don't already do. And at the current stage you will get a little bit of a discount, but there is probably still room for improvement there. But as long as the society is going forward, people will still be building houses, bridges, ports, whatever not, and their machines will be in use. So I think this deserves a spot on our buy and hold it forever. Alright, so next one on our list is not a traditional buy and hold forever stock, and it's probably not even considered a good dividend stock yet, but do hear me out before you judge this right now. And what I'm talking about is Microsoft Corporation. Microsoft Corporation has gone through a massive transition from their focus on Windows and this kind of hardware, IT kind of things, into a more like subscription-based software company. They have been putting their focus on software, infrastructure, cloud systems, all this kind of thing that has been strengthening their cash flow like crazy. The company has had massive growth the last couple of years, and is really now starting to focus more on investors and paying out dividends and this kind of stuff. They have also opened more to make their systems compatible with different kind of systems, so you can also find their products at Apple and all these kind of other platforms that they've not been historically, which means that they are really pushing themselves into a sweet spot when it comes to IT infrastructure. And to tick off a couple things here, the company is 45 years old, so it's not fresh out of the kindergarten just yet, and they have been paying out dividends for 16 years. It's a growing dividend still, but they are still trying to pick up the pace here. It's currently at 0.98%, so it's not a very huge dividend, but they have a very strong cash flow and their balance sheets are solid. So I definitely see this is a company that is going to keep improving their dividend. It's going to keep growing now that they are still finding more balance, and at long term this is definitely going to be worth the list. So long term this stock definitely deserves a spot on our list. This is going to be one of the best dividend companies, I'm sure of it, and they will keep finding their sweet spot there and keep integrating themselves in different kind of things around IT infrastructure. Rather than being a hardware company, they are now more focused on subscription based products, and this is probably a way forward for them. So if you're not trying me just yet, put it at least on your watch list, and when they go back down in a correction, do a load up on them. Alright, so to the last spot on our list. This last one is the oldest one of these companies. It's American behemoth, and they have really been deserving their place on this list. I'm talking about Union Pacific Corporation. I mean, who doesn't love trains? Union Pacific has the second largest network in the US after BNSF, but investing in BNFS is kind of hard because they're privately owned by Warren Buffett and Berkshire Hathaway, so Union Pacific has gotta do. They are definitely checking out our list on history. The company is 158 years old and have been operating all along. They have had some rough patches, but they've always gotten back up, and their new revamped company is definitely solid. And now that we are trying to switch from more fossil to more environmental friendly logistics solutions, trains are going to have a new renaissance. There's going to be a lot more transport by train because people are going to get used to having long-term dry goods being transported on rails rather than trucks, cars, all this kind of stuff. So the only thing you should be noticing here is that for a company that is so old, they only have 14 years of the dividend growth. They did have a rough patch a couple of years ago that they had to restructure a little bit of their business and rebalance some budgets, but they got out of it pretty well, and now it's a cash machine. They also have a dividend a little bit in the middle of everything else we've been looking at today. It's at 2.08%, so it's not really on top of that sweet spot that we wanted it, but it's really up there somewhere. There's little risk in this company because it's such a huge infrastructure-based company. So I think this, if it goes a little bit back down, you should be able to put this at a sweet price and add it to your portfolio. So that compiles my list of 5 companies that I think you should buy and hold forever. I hope you found some interesting names on this list. If you did, please do let me know down in the description below. And as always, I do keep posting my stories down on Medium, so there's gonna be a link for that also down below. And if you want to check out Seeking Alpha, I'm gonna put the link, as I said previously, in the description. I do put a updated version of my dividend portfolio on Seeking Alpha every quarter, so if you want to check that out, go to have a look. And yeah, thank you guys for watching. Please remember to like and subscribe the video, it helps me out immensely. And I'll see you again next time.